In this video, we're going to talk about the coming commercial real estate crash. Almost a quarter of office building loans need to be refinanced in the next year at higher rates. Over the next 24 months, more than 50% of the over $2 trillion commercial mortgage market will need to get renegotiated or refinanced. The Federal Reserve has raised interest rates 9 times from 0 to 4.75%, and it's expected to approve a 10th rate hike during the next meeting, which is scheduled May 2nd to 3rd. Lower quality office buildings where vacancy rates are highest right now are at the greatest risk of default. On a bright note, industrial, retail, and hotels are solid. So when people talk about the commercial loan crisis, it's really mainly about office buildings. The vacancy rate for office buildings rose to a record high 18.2% by late 2022, according to the brokerage giant Cushman & Wakefield, topping 20% in key markets like Manhattan and Atlanta. In SF, it's over 30% in fact. According to Lisa Chalette from Morgan Stanley, office and retail property valuations could plummet as much as 40% from peak to trough this year as higher interest rates make it harder for investors to refinance trillions in looming debt. In SF, there's an office building located at 350 California Street that was worth $300 million 4 years ago. Since then, it lost its anchor tenant Union Bank and is now 75% vacant. The building is likely worth 80% less. Imagine if a bank had just a 50% loan on that $300 million valuation. Complicating the matter is the fact that small and regional banks are the biggest source of credit to the trillion-dollar commercial real estate market, holding about 80% of the sector's outstanding debt. Regional banks are at the epicenter of the upheaval within the financial sector, and there are concerns that the turmoil could make lending standards dramatically more restrictive. Here's a summary. We have over $1 trillion of debt that has to get refinanced in the next 2 years. Rates are going to be about 3 to 4% higher if interest rates stay roughly the same. Vacancy rates are higher than ever for those office buildings. Lending standards have tightened and will probably continue to tighten as values drop. Regional banks, which is where most of the commercial lending happens, are facing huge outflows of customers since the banking crisis. Given all of the above, investors really have 3 options. 1, refinance or renegotiate at terms that are much more restrictive. 2, sell, which right now is an awful time. Or 3, default. If investors try to refinance, the main issue is that the loans that come due will have to be refinanced at higher rates, which will mean higher payments even as vacancy rates rise or remain high. Higher vacancies mean some buildings are worth less, so banks are less willing to touch them without really tough terms. The Fed knows this is a problem, but officials including Jerome Powell have stressed that the collapse of Silicon Valley Bank and Signature Bank were outliers whose failures had nothing to do with real estate. Let's take a look at some of the actual numbers. Take Pittsburgh-based PNC Financial or Cincinnati-based Fifth Third, 2 of the biggest regional banks. At PNC, the $36 billion in commercial mortgages on the books is just a small fraction of the total $557 billion in assets. Only about $9 billion of the loans are secured by office buildings. At Fifth Third, commercial real estate represents $10.3 billion of the $207 billion in assets. Only 0.6% of PNC's loans are past due, with delinquencies lower among commercial loans. At Fifth Third, only $10 million of commercial real estate loans are delinquent right now. Let's look at Wells Fargo, the nation's biggest commercial lender. Last year, Wells Fargo's charge-off for commercial loans was 0.01% of the bank's portfolio, according to its annual report. Write-offs on consumer loans were 39 times higher. So at the moment, it seems like it's all under control, but this doesn't account for the fact that most of the commercial mortgages have to get refinanced in the next 2 years. In fact, Wells Fargo just increased its estimate for bad loans from $186 million in Q4 2022 to $725 million in Q1 2023. That's a huge increase. The primary way real estate could cause problems for the economy is if there's an extended decline in the value of commercial properties, rates remain high, and vacancy stay high, which will make it harder for investors to refinance, leading to a wave of defaults. This will cause banks to tighten lending standards further. This will also disproportionately affect smaller regional banks where most commercial lending takes place. Also, regional banks are where most small businesses acquire loans as well. Regional banks are at the center of the U.S. economy. If banks take enough losses, it can cause them to tighten lending standards for everyone, further restricting the economy. It seems like it's all under control, but control is often an illusion. So we'll keep a close eye on it. If you like my video, please hit the subscribe button and we'll have more content in the days and weeks to come. Thanks so much.